36 hours. That is all the time remaining before the global silver market fractures into three separate realities. Right now, as this voice reaches the audience, there is no longer a single price of silver. Shanghai is paying $84 per ounce. New York shows 72. And the COMEX delivery requests have just spiked 26 times above normal. In less than 2 days, China's export prohibition becomes active law. But the panic has already begun. 3 markets, 3 prices, 1 metal, and someone is about to be left holding nothing but paper. Welcome to Financial Revelations, the channel where economic truth is spoken plainly, without decoration, without distraction. For those who have built businesses, managed capital, or simply understand that information is the first line of defense in uncertain times, this is the place. If wisdom and experience have taught that real analysis requires patience, then consider adding this channel to the watch list. The subscribe button exists for a reason, and those who value strategic economic intelligence tend to use it. One question before proceeding: from which corner of this interconnected world is this broadcast being received? Is it North America, Europe, Asia, the Middle East, or perhaps somewhere monitoring these developments even more closely? The location matters, because what unfolds in the next 4 parts will affect every region differently. Now, to the analysis. The clock is moving. 36 hours from now, the world will wake up to a market that no longer functions the way it did yesterday. This is not speculation. This is not theory. This is documented reality unfolding in real time across 3 continents. On January 2nd, 2025, China's export prohibition on antimony and related strategic minerals becomes enforceable law, and the global industrial system is not ready. But here is what most analysts are missing. The crisis has already started. China controls 48% of the world's antimony supply and 63% of global refining capacity. These are not mere statistics. These are choke points. Antimony is essential for flame retardants, battery technology, and semiconductor manufacturing, but it also plays a critical role in silver alloy production. And silver sits at the center of everything. Solar panels cannot be manufactured without it. 5G infrastructure requires it. Electric vehicles depend on it. And the global electronics industry consumes more of it every single year. Now, both metals are being restricted simultaneously. On December 30th, something unusual happened at the COMEX Futures Exchange in New York. Delivery requests for physical silver spiked 26 times above normal levels. 26 times. This is not routine profit-taking. This is not standard contract settlement. This is panic masked as procedure. When futures traders suddenly demand physical delivery instead of rolling contracts forward, it means one thing. They no longer trust the paper market to reflect reality. They want metal, not promises. And when delivery requests surge by this magnitude, it signals that sophisticated institutional players believe physical supply is about to become scarce or unavailable entirely. This is where the story becomes critical. As of December 31st, silver is no longer trading at a single global price. The market is fractured into 3 distinct tiers, and each tier tells a different part of the story. In Shanghai, where China's industrial manufacturers are scrambling to secure inventory before the prohibition takes effect, silver closed at $84.55 per ounce. This is the panic price, paid by entities that actually consume the metal, entities that cannot afford to wait, entities that know what is coming. In Dubai and the physical trading markets of the Middle East, silver is changing hands at $79.61 per ounce. This is the honest physical market, not in total panic like China, but tight, demanding a premium, reflecting real supply and demand without interference. And then there is New York, the COMEX spot price. The price displayed on banking apps and financial terminals across the Western world shows $72.15, $12 lower than Shanghai, $8 lower than Dubai. This is the zombie price. The ghost, the number that no longer reflects actual transactions in the physical world. The divergence between paper price and physical reality is not new, but the scale of this divergence is unprecedented in modern commodity markets. When the price in one market is 17% higher than another market for the same physical asset, and arbitrage cannot close the gap, it means the market structure itself is breaking. Capital controls prevent Chinese buyers from accessing cheaper Western silver. Shipping logistics and export restrictions prevent Western silver from reaching Chinese buyers, and the result is 3 separate markets operating under 3 separate realities. This is not a temporary dislocation. This is the beginning of a bifurcated commodity system, where strategic materials no longer flow freely based on price, but are allocated based on geography, jurisdiction, and political access. 36 hours. That is how long remains before the export prohibition becomes active. But the industrial world does not operate on 2-day notice. Manufacturing supply chains are planned months in advance. Inventory buffers are calculated based on predictable flows, and procurement departments are not designed to handle sudden supply shocks of this magnitude. The scramble that is visible in Shanghai right now will reach Europe by mid-January and North America by February. The question is not whether disruption will occur. The question is who will be prepared and who will be caught without alternatives. The convergence point has arrived. There is a map that most people have never seen. It does not appear in business textbooks. It is not discussed in quarterly earnings calls, and financial news networks rarely mention it. But this map exists, and it traces the invisible threads that connect a single metal to nearly every piece of modern technology in existence. Silver. Not the silver that sits in investment portfolios, not the silver that collectors admire, but the silver that makes the contemporary world function. And right now, those threads are being cut, one by one. The hidden foundation of industrial civilization. Consider a solar panel. The average photovoltaic cell contains approximately 20 grams of silver, embedded in microscopic lines that conduct electricity with unmatched efficiency. No other material can replace it at scale. Not copper, not aluminum, not graphene composites, still trapped in laboratory research. Silver's unique combination of electrical conductivity, thermal performance, and resistance to corrosion makes it irreplaceable in this application. Now consider that global solar panel production exceeded 400 gigawatts in 2024. Each gigawatt requiring approximately 75 metric tons of silver, 30,000 metric tons consumed by a single industry in a single year. And that industry is growing at 23% annually. But solar is only the beginning. Every 5G base station contains silver-coated components that enable high-frequency signal processing. Every electric vehicle uses silver in battery management systems, charging infrastructure, and control electronics. Medical equipment, from X-ray machines to specialized surgical instruments, depends on silver's antimicrobial properties and electrical characteristics. Defense systems, from missile guidance to radar arrays, are built around silver-based circuitry that cannot be substituted without complete redesign. This is the dependency matrix, and it is non-negotiable. The antimony connection, most are missing now layer in the second element, antimony. While silver captures attention, antimony operates in shadow, performing functions that industries assume will always be available. Flame retardants in electronics, plastics, textiles, and building materials all rely on antimony trioxide. Without it, circuit boards become fire hazards. Electrical components fail safety certifications, and entire product lines cannot legally be sold. Battery technology, particularly lead-acid batteries still dominant in automotive and industrial applications, requires antimony to improve performance and longevity. Semiconductor manufacturing uses antimony in specialized doping processes, creating the precise electrical properties needed for advanced chips. And here is the critical intersection. Antimony is also used in silver alloy production, particularly in applications requiring enhanced hardness and durability. China's export prohibition does not just restrict antimony as a standalone material, it restricts antimony derivatives, alloys, and intermediate products, which means silver refiners outside China now face raw material constraints even if they secure silver ore. This is not a single supply shock, this is a cascade. The geographic trap. The European Union imports 71% of its refined silver from external sources, with China representing the largest single supplier. Germany's automotive sector, Italy's electronics manufacturing, France's defense contractors all operate on supply chains calibrated to assume Chinese material will remain available. Those assumptions are now invalid. North America is marginally better positioned, with domestic mining operations in Mexico, the United States, and Canada, but refining capacity remains concentrated, and antimony supply is almost entirely import-dependent. India, the world's largest consumer of silver for cultural and industrial purposes, faces immediate shortages as its domestic production covers less than 30% of annual demand. The manufacturing capitals of Vietnam, Thailand, and Malaysia, built on the promise of reliable Chinese inputs, now confront a future where those inputs are restricted or unavailable. When the buffers run dry, most corporations maintain 60 to 90 days of raw material inventory under normal conditions. This is standard supply chain practice, balancing storage costs against procurement flexibility. But these are not normal conditions. Industrial buyers who secured additional inventory in November and December may have extended their buffer to 120 or 150 days. That means shortages will not appear immediately. They will manifest in April, May, and June of 2025. By the time most companies recognize the severity of the constraint, spot markets will already be stripped. Alternative suppliers will be fully committed, and prices will reflect true scarcity rather than temporary tightness. The solar industry will face this first, followed by electronics manufacturers, then automotive suppliers, and finally defense contractors who operate on longer procurement cycles. Each sector will discover the same reality. There is no reserve capacity waiting to be activated, no hidden stockpile ready to stabilize markets, no easy substitution that preserves product performance. The strategic calculation behind the prohibition China did not implement this export restriction by accident. For more than a decade, Chinese state policy has systematically consolidated control over critical mineral processing, not through military force, but through industrial investment, environmental regulation arbitrage, and patient capital deployment. While Western nations shuttered refineries due to environmental compliance costs, China built capacity. While global mining companies focused on quarterly earnings, Chinese entities secured long-term supply contracts. The result is a processing monopoly that cannot be replicated quickly, or cheaply, or without significant political will. The export prohibition is not punitive, it is strategic. It reserves critical materials for domestic industrial champions. It creates competitive advantage in downstream manufacturing, and it reminds the global system who controls the choke points. The dependency matrix is complete, and the exits are closing. There's a moment in every market crisis when the machinery itself begins to break. Not the assets, not the prices, but the architecture, the invisible infrastructure that allows buyers and sellers to meet, contracts to settle, and trust to function. That moment has arrived. What is unfolding in silver markets is not a price movement, it is a structural failure. And the cracks are appearing in places most investors do not know to look. The delivery anomaly that reveals everything. December 30th, 2024. A routine day by most measures, markets operating normally, no dramatic headlines, no circuit breakers triggered. But beneath the surface, something extraordinary occurred. Delivery requests for physical silver on the COMEX futures exchange spiked to 26 times normal volume. To understand why this matters, one must understand what futures contracts actually represent. In normal market conditions, less than 3% of futures contracts result in physical delivery. Traders buy and sell contracts, capture price differences, roll positions forward, and settle in cash. The futures market exists primarily for price discovery and hedging, not for moving physical metal. But when delivery requests surge, when sophisticated traders suddenly demand the actual asset instead of paper settlement, it signals a fundamental break in confidence. They no longer believe the paper price reflects physical availability. They no longer trust that contracts can be settled in metal when needed. They are moving first before the crowd realizes what is happening. The warehouse, Paradox COMEX, maintains a network of approved warehouses where physical silver is stored to back futures contracts. As of December 28th, total registered inventory, the metal actually available for delivery against contracts, stood at approximately 82 million ounces. Eligible inventory, metal stored in COMEX facilities but not designated for delivery, adds another 230 million ounces. At first glance, this appears adequate, but here's the problem. Outstanding open interest in COMEX silver futures represents claims on more than 900 million ounces. 900 million ounces in paper claims versus 82 million ounces available for immediate delivery. This is not unusual. Futures markets always operate with fractional backing. It is the nature of derivatives. But when delivery requests spike 26-fold, the mathematics change. If even 10% of contract holders demand physical settlement, registered inventory is insufficient. If 20% demand delivery, the system breaks entirely. The three-tier price structure and what it means. Return to the price divergence. Shanghai, $84.55. Dubai, $79.61. New York, $72.15. In a functioning global market, this spread cannot exist. Arbitrage traders would immediately buy in New York, sell in Shanghai, pocket the $12 difference, and the prices would converge within hours. But arbitrage is not happening. Why? Because the barriers are not financial, they are structural. Chinese capital controls prevent yuan from flowing freely to purchase dollar-denominated assets. Export restrictions prevent physical silver from leaving Western jurisdictions to enter Chinese ones. Shipping logistics, insurance requirements, and jurisdictional complications mean that even when arbitrage is theoretically profitable, it is operationally impossible at scale. The result is three markets operating in isolation, each reflecting local supply and demand, with no mechanism to equalize prices. This is not temporary market inefficiency. This is the emergence of a fragmented commodity system, where geography determines price more than supply and demand fundamentals. Counterparty risk in a fractured market. Now consider the financial institutions sitting at the center of this structure. Major bullion banks, the entities that provide liquidity in precious metals markets, maintain large short positions as part of their market-making function. Under normal conditions, these positions are hedged, managed, and relatively safe. But when physical delivery requests surge, When prices diverge across jurisdictions, and when inventory becomes constrained, those short positions become exposed. If a bank is short 10 million ounces at $72 and suddenly must deliver at $84, that is a $120 million loss per contract cluster. Multiply that across multiple institutions, multiple contract months, and multiple metals experiencing similar dynamics, and the losses become systemic. This is how the nickel market broke in March 2022. The London Metal Exchange halted trading, canceled trades, and restructured contracts because a single participant faced losses so large they threatened the entire clearinghouse system. Silver is larger, more widely held, and more critical to industrial supply chains than nickel. If a similar break occurs here, the consequences extend far beyond financial markets. The feedback loop. Accelerating the crisis. Here is where monetary demand collides with industrial need. As physical shortages become apparent, investment demand increases. Investors buy silver coins, bars, and exchange-traded funds, removing metal from available supply. This tightens the physical market further, which drives prices higher in Shanghai and Dubai, which attracts more investment demand, which removes more metal from circulation. Meanwhile, industrial users who delayed procurement, hoping prices would stabilize, now panic and attempt to secure inventory at any cost. This creates a bidding war between investment buyers seeking stores of value and industrial buyers who need the metal to keep production lines operating. Both groups are rational. Both groups have legitimate reasons to acquire silver, but there is not enough supply to satisfy both simultaneously. When benchmarks become meaningless, the London Silver Fix, the COMEX spot price, the standard benchmarks used to value billions of dollars in contracts, derivatives, and inventory no longer reflect transaction reality. A manufacturer in Germany cannot purchase silver at $72. An electronics company in India cannot secure supply at the New York quote. The benchmark has become a fiction, a number that appears on screens but has no connection to actual exchange. This creates chaos in corporate finance departments. How does a CFO value inventory when the official price is $12 below the actual acquisition cost? How does a procurement officer budget for raw materials when the market price and the transaction price exist in different realities? How does a derivatives trader hedge exposure when the underlying asset no longer trades at the reference price? These are not theoretical questions. These are operational crises unfolding in real time across dozens of industries. The architecture is cracking, and no one is coming to repair it. The question is no longer whether disruption will occur. The question is who will navigate it, and who will be consumed by it. What separates those who survive market dislocations from those who do not is not luck. It is not timing. It is preparation combined with information asymmetry, and right now that asymmetry is stark. The allocation decision that cannot be delayed. For business owners, entrepreneurs, and corporate decision makers, the first strategic choice is deceptively simple. Physical ownership or paper exposure. Exchange-traded funds holding silver appear convenient, liquid, and professionally managed. But convenience is not the same as security. ETFs hold metal in centralized vaults, often commingled across multiple client accounts, and subject to redemption restrictions during market stress. When delivery requests overwhelm physical supply, ETF sponsors can suspend redemptions, settle in cash, or impose penalties that eliminate any price advantage. This has already occurred in other commodity markets under extreme conditions. Physical ownership, direct possession, or allocated storage in the owner's name eliminates counterparty risk entirely, but it introduces logistics, storage costs, insurance requirements, and verification challenges. The choice is not about which option is universally superior, it is about which risks the decision maker is willing to accept. And in a market fracturing across jurisdictions, counterparty risk is rising faster than storage costs. Geographic jurisdiction and the new commodity border. Where metal is stored now matters as much as whether it is owned. Silver held in London, Zurich, Singapore, or New York exists under different regulatory frameworks, different tax treatments, and different levels of political stability. More critically, jurisdictional location determines accessibility during crisis. If export restrictions expand, if capital controls tighten, if governments invoke emergency economic powers, metal stored in certain locations may become effectively frozen regardless of ownership documentation. Switzerland has historically offered neutrality and strong property rights. But even Swiss vaults are not immune to international pressure during systemic stress. Singapore provides legal clarity and efficient logistics, but operates within an Asian regulatory environment increasingly influenced by regional political dynamics. The United States offers rule of law and deep markets, but also carries the risk of government intervention if strategic material shortages threaten national security. There is no perfect jurisdiction. There is only informed choice based on individual risk tolerance and operational needs, the counterparty evaluation framework. In a market where physical delivery has become contested, vetting suppliers becomes critical intelligence work. Not all refiners are equal. Not all storage providers maintain actual segregated inventory. Not all dealers can fulfill orders when spot markets tighten. The evaluation framework must include 3 elements. First, provenance verification. Can the supplier document the origin and chain of custody for the metal being sold? In an environment where counterfeit bars and impure alloys circulate, independent assay verification is non-negotiable. Second, balance sheet strength. Does the counterparty have sufficient capital to weather market volatility without defaulting on delivery obligations? In March 2022, several smaller bullion dealers failed when nickel price swings created margin calls they could not meet. The same risk exists here. Third, operational capacity. Can the supplier actually access physical metal in meaningful quantities? Or are they simply intermediaries, relying on upstream sources that may themselves be constrained? Direct relationships with refiners or primary storage facilities offer more security than multi-layered distribution chains. Material substitution and the industrial adaptation timeline. For corporations dependent on silver for manufacturing, the strategic question becomes substitution. Can alternative materials replace silver in critical applications without compromising product performance? The answer varies by use case. In photovoltaic cells, research into copper-based conductive pastes has advanced, but efficiency losses remain between 3 and 7% compared to silver. For a solar manufacturer operating on thin margins, that efficiency gap translates to competitive disadvantage. In electronics, some applications can shift to gold or platinum group metals, but at significantly higher cost, eroding profitability. In medical devices, antimicrobial properties are essential, and no material matches silver's effectiveness at comparable cost. The timeline for meaningful substitution is measured in years, not months. R&D cycles, testing protocols, regulatory approvals, and production retooling cannot be compressed arbitrarily. Companies that begin substitution research now may have viable alternatives by 2027 or 2028. Companies that delay will find themselves trapped in a tightening vice, unable to secure material, unable to substitute, and unable to fulfill customer contracts. Supply chain. Restructuring and the refining capacity gap. The deeper strategic move is supply chain restructuring, building or securing access to refining capacity outside China's control. Several Western governments have announced initiatives to rebuild domestic critical mineral processing. The United States Inflation Reduction Act includes provisions for strategic material refining. The European Union's Critical Raw Materials Act aims to reduce import dependence. Australia has launched programs to expand downstream processing of domestically mined ores, but announcements are not capacity. Building a modern refinery requires permitting, environmental compliance, capital investment, and technical expertise. The timeline from groundbreaking to operational output is 3 to 5 years under optimal conditions, and these are not optimal conditions. Labor shortages, equipment lead times, and regulatory hurdles extend timelines further. Corporations that secure offtake agreements with planned facilities now, locking in future supply before the facilities even exist, will have strategic advantage. Those that wait for capacity to come online before negotiating access will find themselves competing in bidding wars. The macro forces that amplify everything. Now layer in the broader economic context. Inflation remains structurally embedded in most developed economies. Central banks have paused rate hikes but not reversed them, and fiscal deficits continue expanding. In this environment, tangible assets with industrial utility become dual-purpose holdings. They serve operational needs, and they function as inflation hedges. For businesses with strong balance sheets, allocating capital to strategic material inventory becomes a form of treasury management. Purchasing 6 months of silver supply today at $79 locks in costs and protects against further price escalation. If prices rise to $90 or $100 by mid-2025, that inventory position generates immediate P&L benefit. If prices stabilize or decline, the metal still serves its intended industrial purpose. This is not speculation, it is risk management. The information asymmetry that determines outcomes. Traditional financial media operates on a 24-hour news cycle optimized for advertising revenue and viewer engagement. Complex commodity market dynamics do not fit that format. As a result, the average investor, and even many corporate procurement professionals, are receiving information that is incomplete, delayed, or actively misleading. The COMEX spot price displayed on Bloomberg terminals does not reflect physical transaction reality. News coverage focuses on percentage moves rather than structural supply changes. Analyst reports rely on data sets that lag actual market conditions by weeks or months. Meanwhile, institutional players, Sovereign wealth funds and strategically positioned corporations operate with real-time intelligence. They monitor Shanghai premiums hourly. They track COMEX warehouse inventory daily. They maintain relationships with refiners that provide advance notice of production constraints. This is the information asymmetry that determines who captures value and who absorbs losses during dislocations. The 90-day scenario, the 180-day scenario, the 12-month scenario. Over the next 90 days, expect continued price divergence across markets, increasing delivery delays, and rising premiums for physical metal. Industrial buyers with insufficient inventory will begin experiencing production constraints. Over the next 180 days, some manufacturing sectors will face forced shutdowns due to material unavailability. Weaker suppliers will default on contracts. Consolidation will accelerate as companies with inventory acquire competitors without it. Over the next 12 months, the global silver market will operate under a fundamentally different structure than existed in 2024. Physical allocation will be determined by strategic relationships rather than spot market pricing. Industries dependent on silver will bifurcate into those with secured supply chains and those perpetually scrambling for material. And a new pricing architecture will emerge, one where paper markets and physical markets exist as separate systems with limited interaction. The business intelligence imperative: none of this is secret. The data exists, the market signals are clear, the structural forces are documented, but data without interpretation is noise, and interpretation without action is entertainment. The entrepreneurs and business leaders who treat this analysis as actionable intelligence rather than interesting information will be positioned correctly when the majority realizes what has occurred. By then, strategic materials will be allocated, supply agreements will be locked, and the cost of entry into secured supply chains will have multiplied. 36 hours have passed. The prohibition is now active. The question is no longer what will happen. The question is what has already been done.